Hi there. I am seeking to understand small business acquisition as a path for career change by explaining out loud what I think I know and seeking feedback. In this case, from a financial standpoint. Suppose you know your target salary and how much you can bring to a deal. What does it take to make it work? I'm going to define making it work using Live Oak Bank's target of a debt service coverage ratio of 1.5 or greater. And I'm going to frame the conclusion in two categories: first year salary and what percent of the deal is financed. For a 100K first year salary target, it seems like it's possible to have a majority finance deal. For example, a 95% finance deal seems like it's possible to get a robust deal if there are multiples on the EBITDA available in the low end of typical. If the owner can inject 10% cash, there's a much better chance of having a robust deal for a 100K first year salary target. On the other hand, at the higher end of 200K or more, the owner seems to require the owner to bring more cash to the deal to make it possible. 95% or higher financing, in my finding, results in a very low likelihood of finding a robust deal. If the owner can bring 20% or more or find investors seeking return only at exit, there's a decent chance of finding a robust deal. To explain my thinking, I'm going to use 3 different models. First, we're going to look at a very basic model, simple tables, and then we're going to dive into a single scenario in more detail. And finally, we're going to look at the sensitivities and ranges that give us the conclusion that we started with. Under what ranges is it possible to make a deal work? Before we get into the model, let's take a quick look at why I chose the ranges that I did. In terms of salary, I took 2 tacks. One, a super successful tech industry professional, senior software developer, in the 200 to 250K range, and then looking at median salaries across cities, as well as typical hourly ranges to get a 100K and a 200K as represented. Next, let's look at where the parameters for the deal come from. I leveraged this really great self-funded search study from the Search Investment Group, which has feedback from 250 individuals on the parameters of their deals and really fantastic graphs on it. Let's take a look at a few of the graphs. In terms of typical deals, we're going to examine 2. $1 million EBITDA at a 4x multiple and 500K EBITDA at a 3x multiple. For the seller note financing, typical seems to be 10% of purchase price, 8% interest for a 5-year term. On the investor side, the most common vehicle seems to be preferred equity model at 8%. And finally, we're using this as an input, but we're going to find out why the typical owner salary is generally in the 100 to 200K range. Now let's take a look at the simple model parameters. Starting with a $1 million EBITDA deal and a 4x multiple. No earner contribution just to start to explain the structure of this table. 80% SBA financing, 10-year term, 10% seller note, 8% interest, 5-year term, investor covering the gap. We're going to be monitoring these metrics up here. What's left after the debt service, and how does that look in terms of a DSCR given a 100K and a 200K salary? First, let's go to an owner contribution of 100K. This barely dents the DSCR. We're still in a very unfavorable range. If we skip ahead to a owner contribution of 20% of the purchase price, then we're starting to get into DSCRs that make it reasonable. So $1 million, 20% owner contribution, 200K salary is starting to look reasonable. Let's look at a different deal. A 500K EBITDA target with a 3x multiple, no owner contribution. No salary, we're in the range. 100K salary, we're almost there. Let's increase the owner contribution to 100K. Then we're finally in our target range. So this deal, a 500K EBITDA target, 3x multiple, 100K owner contribution, and 100K target salary gets us to a viable deal. Going back to the original deal, Can you see something that I'm missing? In this case, a $1 million deal, 4x multiple, modest owner contribution. This deal does not look viable to me. Am I missing something? Okay, let's jump into a basic model. Starting with $1 million EBITDA at a 4x multiple and no owner contribution, just to get a sense of the layout. In terms of funding sources, we're going to have SBA at 80%, 10-year term, seller covering 10%, 8% interest, 5-year term, and an investor covering the remaining 10%. We're going to be focusing on these metrics up here. What's left after EBITDA and debt service, and what does that mean for our coverage ratios at a range of salaries? Immediately, we can see that this scenario is not working. Let's increase the owner contribution to a modest 100K. Still not close to working. If we skip ahead to a 20% owner cash injection, that takes the investor out of it and brings down our SBA share. We're into good coverage ratios where this deal is starting to look interesting. Let's try another deal. 500K EBITDA at a 3x multiple and no owner contribution. Here we're getting close out of the gate on a 100K salary. We just need to increase the owner contribution. There we are at a 100K owner contribution. We're in the target range for a 100K salary and not close on a 200K salary. If we went again up to the 20% contribution, we're starting to get into the range for a 200K salary. Let's now go back to our original scenario. $1 million EBITDA, 4x multiple, and low owner contribution at 100K. What does it take to make this deal work? What if interest rates were substantially more favorable? Well, we're close on a 100K salary, not quite there on a 200K salary. Now, what if we lowered the multiple? 375, looking good on a 100K salary, not quite there on a 200K salary. We went all the way down to 3.5, we're starting to get into the right range. What's the conclusion here? For $1 million EBITDA, we're looking at needing much more favorable terms on interest rates and price to EBITDA ratios than we see in the market today. What do you think? It looks to me like $1 million EBITDA requires one of a few things to be true. Either the market conditions in terms of the multiple or the interest rates to be much more favorable, the buyer to bring more cash, or investors to accept no return until exit. What am I missing? Let's take a more in-depth and visual look at our baseline scenarios. Here we have $1 million in EBITDA, 4x multiple, owner salary starting at 200K, SBA with 80%, seller with 10%, and the owner contributing 100K. Basically, the issue is that the debt service takes up almost 3/4 of the EBITDA, the owner salary almost the rest of it, bringing our coverage ratio nearly down to 1. Visually, we can see this down here in this graph. We have 3 different coverage ratios, but we're really focused on the green one, coverage ratio after salary, which is really close to 1. In terms of a dollar amount, over here in the EBITDA minus debt service, we have a dashed line showing what it looks like before the owner salary, a baseline in thick black here showing what it looks like after the owner salary, and some positive and negative scenarios in terms of what the EBITDA might do over time. We're really focused on this black line, and we can see there's almost nothing left under the terms of this deal. Remembering from our previous scenario, if we go to an owner contribution of 20% of the sale price, we're into more favorable coverage ratios, and after the debt service, we're almost up to 200K left. Once we clear the investor terms, then we're starting to get into more favorable situation. Let's go back and take a look at the modest owner contribution. What if we increase the range of payback for investors to 10 years? That still doesn't really help us get to a more favorable deal terms. In summary, resetting our parameters, it's really difficult to get the $1 million EBITDA, 4x multiple, and 200K salary to close. Even at 100K, it's still quite difficult. But if we bring the owner contribution up to 20%, then things are starting to get really interesting. Let's now take a look at the next scenario we've been exploring. This is a 500K EBITDA, 3x multiple, 100K owner salary, and 100K owner contribution. Already we can see a big difference. The debt service in this case is covering half of the EBITDA, and we already have a favorable coverage ratio. We can see that getting even more favorable after the investor terms are satisfied. In terms of dollar amount, we're looking at a little over 100K left after debt service and owner salary, which is a little over 20% of the EBITDA for this model. So what have we learned from this? Well, this scenario, 500K EBITDA, 3x multiple, 100K owner salary, 100K contribution to the deal, gives us favorable terms. The other end of our spectrum, 1 million in EBITDA, 4x, and a 200K owner salary, gives us very unfavorable deal terms. As we wrap this up, I just want to point out that, of course, this is a simplified model. We're not considering working capital, a lot of variations that are possible in business operations year over year. Mainly what we're focused on here is trying to understand the parameters under which a deal is possible and favorable, given a target owner salary, EBITDA multiples, and funding terms. Next, we're going to take a look at how we explore sensitivities to try to figure out where does this make sense without plugging in a bunch of numbers all over the spreadsheet, even though that's kind of fun. Okay, next we're going to use this model to allow us to explore a range of deal sizes and multiples at the same time, given an owner salary and standard deal terms. Let's get oriented. We're going to vary the owner salary, take these deal terms over here, which will also be varying, and using the DSCR as our measure of what is a good deal, we're going to take a look at a range of EBITDA and a range of multiples at the same time. We've highlighted these blue boxes here to show the typical ranges that deals can be found in. Over here on the right, we have a more advanced scenario where we're not only varying the EBITDA and the multiple, we're also varying the owner salary at the same time, 100K, 150K, 200K. But we'll focus over here on the left to start. We're going to start varying the owner salary and the owner contribution to try to find a good deal range. Quite simply, we're looking for more green and white inside of these blue boxes. That means we're getting more robust deal. As we lower the owner salary, given the same deal terms, we're starting to find ranges here where multiples and EBITDAs might work out. But we're still not quite there. So let's increase the owner contribution by taking the investor out of the picture. That's starting to look really good. So at 100K salary and 10% owner contribution, things are good. Let's go back to that 200K salary. Not quite enough. We're going to need to lower the SBA contribution, increase the owner contribution to 20% in order to get a lot of options in here where things could work out. So back at our $1 million EBITDA and the 4x multiple, we now have our 1.42 DSCR. If it is possible to find a lower multiple, then things are really robust from a DSCR standpoint. The thing we want to note here is with an owner salary of 200K, 20% owner contribution, we have a wide range of deal sizes that could possibly work. All of these green scenarios and even these white scenarios will apparently be in the range for some lenders, in the 1.25 to 1.5 DSCR. Now let's go back to that owner salary of 100K. What works at this range? We've got a lot of green here. This means it's really favorable. If the owner is bringing 20% and taking 100K salary, there's a wide range of EBITDAs and multiples that will work. Let's increase the SBA share back to 80%, which means the owner is now bringing 10%. We still have a range here where, for example, at 500K EBITDA, we can support a range of multiples from 2.5 almost all the way out to 3.5. At $1 million EBITDA, we can support 3, unlikely that we'll find that, but out to around 4 with a 100K owner salary. In this manner, we can get a sense of what is the range of EBITDA and multiples that work given owner salaries and owner contribution. So where does that leave us in terms of conclusions? In this case, 100K owner salary, 20% owner contribution, we have a wide range of deals that works. As we go to 10% owner contribution, it still looks like there's going to be a wide set of deal parameters that are going to be robust in terms of the EBITDA and the multiple we're seeking. If we go back to the upper end scenario that we've been considering, 200K in owner salary, we start to see the range of possible deals shrinking. And if we go back to that modest owner contribution, around 100K, we see that it's very difficult for the owner, given a target of 200K salary, to find any deals that are going to work with a limited amount down of 100K. So what have we learned, or what do I think I'm trying to articulate? Well, if we walk it back through from this model to the single scenario, the very simple funding model, back to the conclusions we started with, what I find when I study this problem is that a 100K salary, first year target, mostly financed deal is possible. 10% owner contribution makes it a pretty good chance of having a wide range of deals. Targeting a 200K salary or higher, it's very difficult to have an all finance deal work out. It's going to take some owner contribution or an investor who's only seeking return and exit. I'm trying to learn by expressing what I know out loud. I made a lot of simplifying assumptions, and I know this is more complicated. I'm just trying to get a general sense of, if you know where your target salary is, you know what you can bring to a deal, is it possible, is it favorable, is it likely to end up with a robust deal? I'm sure I made a lot of mistakes, but let me know what you think. I'm here to learn.